whole FCCB measures came in and energy prices came down because of what President Trump announced, we did see a flurry of upgrades that happened to growth.
Yeah.
While some people may want to kind of credit it directly to the fall in energy prices, in a way, a lot of these things also seem to have kind of contributed to it. I think right now we're talking about FY27 growing at about 6.8 to 6.9%. So from a growth perspective, the last 45 days, the outlook has improved, like you also alluded to. So from an earnings perspective, therefore, how would you want to kind of go through the next 1 or 2 quarters? Earlier, I think Q1, the June end earnings, everybody was really worried about what's going to happen. But now I think Q1, people are willing to kind of just look through. So how are you looking at earnings for FY27? And more importantly, are there any pockets that you think are standing out better than the rest of or the market average?
Yeah. No, I think that's most relevant for us finally when it comes to portfolio strategy. I think till I think about a month ago, and firstly before of course the conflict began, we were all expecting a roughly about 16 to 18% earnings growth in FY27, right, for the Nifty. And the numbers were much higher for mid and small caps. And what we saw in the fourth quarter of FY26, which is March 26, large caps earnings growth was very subdued, mid-single digits. And then you had the mid and small caps turn in significantly higher numbers. I think 18-20% and 30-35% for mid and small cap respectively. And then, of course, the view then was the fact that probably things have got front-loaded, right? Because the crisis had just broken out, and there was an expectation that probably things have got front-loaded. Now, given that things are looking very volatile, I think the street has been largely buying time on the fact that we are now pretty much done with the first quarter, and therefore we'll want to hear what managements are saying about what is the impact of the crude price and not only the crude price but prices of several commodities, right? So many commodities prices have gone up.
I think we've seen a lot of these.
Memory chips, I mean, you see the price hikes in mobile phones and laptops. So pretty much everything, there has been a significant cost pressure. So of course, one is wanting to see therefore the impact of that on demand. And therefore watching management commentary on profit margins and the outlook on demand will be a very key monitorable for 1Q. Thus far, I think, like I said earlier, the demand indicators, the high frequency demand indicators seem to suggest that we are kind of chugging along quite well. So you look at credit growth, which is at 18%. You look at power demand, first 2 months looking at 7%, third month also looking quite good. The auto volumes are looking quite good. Parts of the real estate part of the economy seem to be chugging along quite well. The top 8 cities in the country, I think sales have been quite good. So I think those indicators seem to suggest that things are kind of fine. And therefore, one probably need not take out the knife on FY27 earnings. But I think it's better to wait and watch for these indicators. I think that's really where we are insofar as saying that from a portfolio strategy, how should we approach earnings for FY27? We're saying that let's hear management commentary for FY27. Now that said, how do you build an equity portfolio today? I mean, which parts of the market one should focus on? I think while, of course, valuations have been higher in mid and small caps, and they've been so for quite some time now, I think somewhere the earnings is coming through in that space. And while
earnings there have been upwards of what, 25-30%, I think, even in FY26.
Absolutely. So I think that's coming through, and therefore that is giving comfort to investors insofar as valuations are concerned. The large cap space, the earnings have been pretty muted, and the subdued valuations there probably reflect that as well. In so far as the pockets are concerned, the pockets of opportunities are concerned, if you kind of look at it from the prism of the spaces that are occupied typically by the large caps and the mid caps, you would get a better sense of where the economy is kind of moving. So if you look at the large cap space, you typically have the banks, you have the IT companies, which are the large ones, and oil and gas and petrochem, and those kind of names. Whereas the mid and small have a lot to do with this whole power.
In a way, powering the next phase of growth.
Yes.
Yes.
So the entire complex on industrial goods and electrical equipment and the entire value chain over there, and of course the data center related thing, the energy transition thing, all of that you find mostly in the mid and small cap space. So therefore, when we look at portfolio strategy, I think we look at which part of the economy is doing well, and when you see this, when you see that industrials and that bit firing, we prefer to kind of overweight the portfolio on that side. So therefore, that's a space that we are a lot more constructive vis-a-vis probably more defensive, erstwhile defensive sectors like IT or an FMCG. Some of these are seeing very structural kind of challenges that they are grappling with, as we know.